The financial world just shifted beneath our feet, and most people have no idea what's coming. While mainstream media focuses on stock market noise and political theater, something extraordinary is happening in the gold market that could reshape wealth for generations. And here's what nobody's telling you. The window to position yourself is closing faster than anyone realizes. Let me show you what's really going on behind the scenes, because what I'm about to reveal isn't speculation or theory. This is documented, verifiable, and happening right now in real time across global financial markets. Central banks around the world just completed their third consecutive year of purchasing over 1,000 tons of gold. Think about that number for a moment. 1,000 tons. That's not a small adjustment to their reserves. That's not portfolio rebalancing. That's a fundamental shift in how the world's most powerful financial institutions view the future of money itself. But here's where it gets interesting. These aren't random purchases scattered across time. The buying accelerated dramatically during price pullbacks. When gold dipped, central banks didn't hesitate. They didn't wait for confirmation. They bought aggressively, treating temporary weakness as opportunity. That tells you everything you need to know about their conviction level. Now, who exactly is doing this buying? We're talking about institutions that manage trillions in assets. The People's Bank of China recently resumed purchases after a brief pause, adding to reserves at a pace that caught markets off guard. Poland's central bank has been accumulating steadily. Turkey continues building one of the fastest-growing gold reserves in the world. India's central bank remains a consistent buyer. These aren't small players making emotional decisions. These are sophisticated institutions with access to information and analysis that most investors will never see. And here's what makes this moment so critical. They're buying while prices are still within reach for individual investors. History shows us that once institutional accumulation reaches a certain threshold, prices don't just rise gradually. They explode higher as the reality of supply constraints hits the broader market. Let me paint you a picture of what's actually happening in the physical gold market right now. The London Bullion Market Association, which handles the majority of global gold trading, has seen something remarkable. Demand for physical delivery has surged while available inventory has tightened. This isn't about paper contracts or financial derivatives. This is about actual metal changing hands, moving from vaults in London to vaults in Beijing, from refineries in Switzerland to central bank storage facilities across Asia and the Middle East. The mechanics of this are fascinating. When you look at COMEX data, the major futures exchange for precious metals, you see something that should alarm anyone paying attention. The ratio of paper claims to physical metal has stretched to levels that would be unsustainable in any other market. Imagine if every person who owned a claim ticket for a car actually tried to take delivery of that car, only to discover there aren't nearly enough cars to go around. That's essentially what's building in the gold market, except the stakes are infinitely higher because we're talking about the foundation of the global monetary system. Now, why does this matter to you? Because we're watching the early stages of a supply squeeze that could make previous gold rallies look modest by comparison. And the catalyst isn't some future event we're waiting for. The catalyst is already here. It's the accumulation happening right now, the tightening of physical supply, the growing recognition among major institutions that the current monetary system has fundamental problems that gold solves. Think back to what happened in the early 2000s. Gold was trading around $300 an ounce. Most investors ignored it. Financial advisors dismissed it as a relic. Then something shifted. Smart money started accumulating. Central banks that had been sellers for decades suddenly became buyers. And over the next decade, gold didn't just rise. It multiplied nearly 6 times, reaching over $1,900. But here's what most people miss about that move. The biggest gains didn't come from the people who bought at $300, though they did extraordinarily well. The biggest gains came from the people who recognized the trend early enough to position size appropriately and hold through the volatility. They understood that when a fundamental shift occurs in how the world values an asset, the move isn't linear. It's exponential. We're seeing similar patterns now, but with even more powerful underlying dynamics. The difference between then and now is the scale of monetary expansion, the level of global debt, the fragmentation of the international monetary system, and the speed at which major economies are diversifying away from dollar dependence. Let me give you some context on what's driving this. Global debt has reached levels that would have been unimaginable just 2 decades ago. We're talking about debt to GDP ratios in major economies that exceed anything seen outside of wartime. And here's the thing about debt at these levels. It can't be paid back through traditional means. It can only be managed through financial repression, which means keeping interest rates below the rate of inflation, effectively eroding the purchasing power of currency over time. Central banks understand this dynamic intimately. They're the ones implementing these policies. And that's precisely why they're accumulating gold. They're not buying gold because they think it's going to generate yield or pay dividends. They're buying gold because they understand that in a world of competitive currency debasement, gold is the only asset that can't be printed, can't be debased, and maintains its purchasing power across generations. Now let's talk about what's happening in the industrial and jewelry sectors, because this adds another layer to the supply-demand equation. Gold isn't just a monetary asset. It's a critical component in electronics, medical devices, aerospace applications. As technology advances, industrial demand for gold continues growing. Meanwhile, jewelry demand, particularly from Asia, remains robust despite higher prices. This creates a floor under the market that didn't exist in previous cycles. But here's where the story gets really compelling. We're watching the emergence of a new monetary architecture. The BRICS nations have been openly discussing alternatives to dollar-based trade settlement. They're not just talking about it in abstract terms. They're implementing bilateral trade agreements denominated in local currencies. They're building payment systems that bypass traditional Western financial infrastructure. And at the center of many of these discussions is gold as a neutral settlement asset. Imagine you're Russia or China, and you're looking at how Western nations use the financial system as a weapon, freezing reserves and cutting off access to SWIFT. What's your logical response? You diversify away from assets that can be frozen or seized. You accumulate assets that exist outside the traditional banking system. You build reserves in something that has been recognized as money for 5,000 years. Something that no government can simply print away or confiscate with a keystroke. This isn't conspiracy theory. This is documented policy from multiple nations representing billions of people and trillions in economic output. And the implications for gold prices are staggering. Now, here's something most investors don't consider. When you look at gold priced in dollars, you're only seeing half the picture. Gold has been hitting all-time highs in numerous other currencies: the Japanese yen, the British pound, the euro. Investors in those countries who held gold have been protected from currency devaluation in ways that holders of bonds or cash simply weren't. And this brings me to something crucial for anyone thinking about their financial future. If you're sitting on significant retirement savings, if you have $100,000 or more in traditional retirement accounts, you need to understand how gold can fit into that picture. I've put together a comprehensive guide on how gold IRAs actually work, how you can get physical gold into your retirement account without triggering tax penalties, and what you need to know about the process. It's completely free, and you'll find it in the description below. This isn't about making a sales pitch. This is about making sure you have the information to make informed decisions, about protecting wealth you've spent decades building. Because here's the reality. The strategies that worked for the past 40 years might not work for the next 40. We're in a different monetary environment, with different risks and different opportunities. And gold represents one of the few assets with a proven track record of preserving purchasing power through every type of economic crisis humanity has faced. Now, let's get back to what's happening in the market right now, because the technical picture is just as compelling as the fundamentals. Gold recently broke through resistance levels that had held for months. When you see that kind of breakout accompanied by strong volume and institutional buying, it's typically not a false move. It's the beginning of a new leg higher. Chart patterns are showing something that technical analysts call a cup and handle formation on the longer-term time frames. This is one of the most reliable bullish patterns in technical analysis, and it typically precedes significant upward moves. The cup represents a period of consolidation and base building. The handle represents a final shakeout of weak hands before the real move begins. And we're right at that inflection point now. But technical analysis only tells you what's happening. It doesn't tell you why, and the why is what gives you conviction to hold through inevitable volatility. So let me explain what's really driving this move from a fundamental perspective. The mining industry is facing challenges that most people don't appreciate. Gold production has essentially plateaued. Despite higher prices, despite improved technology, despite massive capital investment, the industry isn't finding and developing new deposits fast enough to offset depletion of existing mines. This means that every ounce of new demand has to come from either recycling or higher prices that bring out sellers. And with central banks as aggressive buyers, they're effectively removing supply from the market permanently. Think about what that means. If production is flat and central banks are buying over 1,000 tons per year, that's 1,000 tons that's not available for jewelry, not available for industrial use, not available for investment demand from individuals. It's locked away in vaults, likely never to return to the market. This creates a structural deficit that can only be resolved through significantly higher prices. Now, let's talk about what happened in previous supply squeezes, because history provides a roadmap for what might be coming. In the late 1970s, gold went from around $100 to over $800 in just a few years. What drove that move? A combination of inflation, currency instability, geopolitical tension, and a loss of confidence in the monetary system. Sound familiar? But here's what's different now. In the 70s, gold was coming off a period where it had been fixed at $35 per ounce by government decree. When that peg broke, price discovery was violent and dramatic. Today, gold trades freely, but we're seeing similar dynamics of monetary instability and geopolitical fragmentation. The difference is the scale. The amount of currency in circulation today dwarfs what existed in the 70s. The level of debt is exponentially higher. The complexity of the financial system is orders of magnitude greater. This suggests that when gold makes its move, it won't be constrained by the same factors that eventually capped the 70s rally. There's simply too much liquidity in the system, too much debt that needs to be inflated away, too many reasons for central banks to keep accumulating. Let me share something that really crystallizes what's happening. There's a concept in market analysis called the gold-to-money supply ratio. It measures how much gold exists relative to the total money supply. When you run those numbers today, gold is historically undervalued relative to the expansion of money supply over the past 15 years. If gold were to return to its historical average ratio, we're talking about prices that would shock most investors. But you don't need to believe in extreme scenarios to see the opportunity here. Even a modest reversion to mean would represent substantial gains from current levels. And that's before accounting for any acceleration in central bank buying, any escalation in geopolitical tensions, any loss of confidence in fiat currencies, any recognition by mainstream investors that gold deserves a larger allocation in portfolios. Now, here's where the psychology of markets becomes crucial. Most investors wait for confirmation before acting. They want to see gold break to new all-time highs. They want to see mainstream media coverage. They want to feel safe and validated in their decision. But by the time all those confirmations arrive, the easy money has already been made. The people who profit most from major market moves are the ones who position themselves before the crowd arrives. And that's exactly what central banks are doing. They're not waiting for CNBC to tell them gold is a good buy. They're not waiting for their neighbors to start talking about precious metals at dinner parties. They're accumulating now, while prices are still reasonable, while supply is still available, while the broader public remains largely unaware of what's building. Think about the psychology of a central banker for a moment. These are people who have spent their entire careers studying monetary systems, financial crises, currency collapses. They've seen what happens when confidence in fiat money breaks down. They've studied Weimar Germany. They've analyzed the collapse of the Roman denarius. They've examined every major currency failure in history. And with that knowledge, they're choosing to accumulate gold at the fastest pace in decades. What do they know that the average investor doesn't? They understand that the current monetary experiment, this era of unlimited money printing and zero interest rates and quantitative easing, is unprecedented in human history. They understand that every previous attempt to create prosperity through currency debasement has ended badly, and they're positioning their nation's reserves accordingly. But here's the beautiful thing about gold. You don't need to be a central banker to participate in this trend. You don't need billions of dollars or access to classified economic data. You can position yourself right alongside the world's most sophisticated institutions, buying the same asset they're accumulating for the same fundamental reasons. Now, let's address something important. Some people look at gold's price and think they've missed the move. They see it trading well above its lows and assume the opportunity has passed. But that's not how major bull markets work. In a genuine bull market, the asset doesn't just go up and stop. It goes up, consolidates, goes up more, consolidates again, and continues that pattern for years. The people who profit most aren't the ones who try to time the perfect entry. They're the ones who recognize the trend early and stay positioned through the volatility. Look at what happened after 2008. Gold was already well off its lows when the financial crisis hit. Many investors thought they'd missed it. But gold went on to nearly double from those levels over the next 3 years. Why? Because the fundamental drivers, the monetary expansion, the loss of confidence in the financial system, the recognition that traditional safe havens weren't actually safe, those drivers continued to intensify. We're seeing similar dynamics now, but with even more powerful catalysts. The monetary expansion since 2008 makes previous periods look modest. The geopolitical fragmentation is accelerating. The debt levels are higher. The recognition among major institutions that the system has fundamental problems is more widespread. All of this points to a move that could make previous rallies look like warm-up acts. And here's something that should really get your attention. Exchange-traded funds backed by physical gold have seen significant inflows recently. This represents investment demand from institutions and individuals who want exposure to gold but prefer the convenience of a security that trades like a stock. When you see ETF inflows accelerating while central banks are buying and industrial demand remains strong, you're looking at a supply-demand imbalance that can only resolve through higher prices. But ETFs are just one piece of the puzzle. There's also been a surge in demand for physical coins and bars from individual investors. Mints around the world have reported difficulty keeping up with demand. Premiums over spot price have widened, indicating that people are willing to pay more to secure physical metal. This is the kind of behavior you see at the beginning of major moves, not at the end. Now let me tell you about something that's happening in the derivatives market that most people never hear about. The options market for gold is showing unusual activity. Large institutional players are buying call options, which give them the right to purchase gold at specific prices in the future. The positioning suggests that sophisticated traders are expecting significant upside, and they're willing to pay premiums to secure that exposure. This kind of positioning doesn't happen in a vacuum. These are traders with access to order flow, with relationships at major banks, with insights into what large institutions are doing. When you see them positioning for upside in size, it's worth paying attention. But perhaps the most compelling aspect of this entire situation is what's happening with the US dollar. For decades, the dollar has been the undisputed reserve currency of the world. Countries held dollars because they needed them for trade, because they were stable, because there was no alternative. That's changing. Not overnight, not dramatically, but steadily and inexorably. Trade agreements are being signed that bypass the dollar. Central banks are reducing their dollar reserves as a percentage of total holdings. Alternative payment systems are being developed and implemented. This doesn't mean the dollar is going to collapse tomorrow, but it does mean that the dollar's dominance is being challenged in ways that have profound implications for anyone holding dollar-denominated assets. And here's the thing about gold. It's nobody's liability. It doesn't depend on any government's promise to pay. It doesn't require faith in any central bank's competence. It simply exists, with properties that have made it valuable for thousands of years. In a world where trust in institutions is declining, where currency manipulation is standard policy, where the rules of the financial system seem to change whenever it's convenient for those in power, gold represents something solid and unchanging. Let me share a perspective that might help frame this opportunity. Imagine you're looking at the market in 2002, and someone tells you that gold is going to multiply 6 times over the next decade. You'd probably think that sounds too good to be true, but that's exactly what happened. And the people who recognized the trend early, who understood the fundamental drivers, who had the conviction to stay positioned through the volatility, they built substantial wealth. Now imagine we're at a similar inflection point today. The fundamentals are arguably more compelling. The monetary backdrop is more extreme. The geopolitical situation is more unstable. The recognition among major institutions is more widespread. If gold were to deliver even half the performance of that previous cycle, we're talking about life-changing returns for people who position themselves now. But this isn't about getting rich quick. This is about recognizing a fundamental shift in the global monetary system and positioning yourself accordingly. This is about understanding that the strategies that worked for the past 40 years, the 60-40 portfolio, the faith in bonds as a safe haven, the assumption that central banks have everything under control, those strategies might not work going forward. The world is changing. The monetary system is evolving. And gold is reasserting itself as the ultimate form of money, just as it has through every previous period of monetary instability in human history. The question isn't whether this trend will continue. The question is whether you'll position yourself to benefit from it while the opportunity is still available. Because here's what nobody's telling you. Windows like this don't stay open forever. There comes a point where the trend becomes obvious to everyone, where mainstream investors pile in, where prices gap higher and never look back. And by that point, the easy money has been made. The people who profit most are the ones who act while the opportunity is still misunderstood, while supply is still available, while prices are still within reach. Central banks understand this. That's why they're buying now, aggressively, consistently, without waiting for perfect entry points. They're not trying to time the market. They're recognizing a fundamental shift and positioning accordingly. And you have the opportunity to do exactly the same thing. The window is closing, not because of some arbitrary deadline, but because the dynamics driving this move are accelerating. Every day, central banks remove more supply from the market. Every day, the recognition of gold's role in the monetary system spreads to more institutions. Every day, the imbalances in the financial system grow larger and more unstable. And every day that passes is a day closer to the point where this opportunity becomes obvious to everyone. So the question you need to ask yourself is simple. Are you going to position yourself alongside the world's most sophisticated institutions, or are you going to wait until the move is obvious to everyone? Are you going to act while supply is available and prices are reasonable, or are you going to watch from the sidelines and wish you'd recognized the opportunity when it was right in front of you? The choice is yours. But understand that this moment, this window of opportunity, won't last forever. The fundamentals are in place. The institutions are accumulating. The supply-demand dynamics are tightening. And the stage is set for a move that could reshape wealth for a generation. The only question is whether you'll be positioned to benefit from it.